Alrighty, let's go ahead and get started. Welcome everyone to TradeFinder Live. Great to be back with you all during this trading day and during trading hours. First and foremost, as always, we do have to cover our disclosure disclaimer agreement. The main thing to take away from this is that we are not licensed investment advisors in the United States, so nothing to be taken as personal investment advice. This is always available on our website to be read in full detail at your leisure, or feel free to take a screenshot of it now if you like, but that's the main point to take away. The Fed speak is sounding a bit more like that December rate cut is coming as consumer confidence is taking. So lots of exciting topics to get into to start this week off and to start this session out. So let's go ahead and kick off. Rob, you out there?
I'm Zach. Hey, everyone. Happy Tuesday afternoon to you. Welcome to TradeFinder Live. And lots to talk about, as Zach said, regarding the markets. Listening to the Fed speak, and gosh, there was some commentary on the financial networks this morning about some of the things that I've been saying is what a different Fed we have now than we had back under Alan Greenspan, where it was so clandestine. They would joke on CNBC where they would watch Greenspan when he was going into the meetings, and they had the quote briefcase indicator. Some of you may have been around long enough to remember those days, but more transparent Fed now, like it or not. Constantly bombarded, seems to seesaw the markets at times, but people seem to like the transparency. But it seems like we've tilted a little bit based on the Fed speak of lately that we will get that December rate cut. It's up to about a 78% chance now. A couple days ago, it was less than a toss of a coin. So you can see we're trending that direction. And then, of course, the NVIDIA news that we'll talk about when we get to the chart of NVIDIA. If you haven't heard that, I'll fill you in on what's going on there. And we also had one of the worst consumer confidence numbers in a long time. In fact, it's the worst number since 2021. And people are trying to figure out why the consumer is so concerned. And they're talking about higher prices. I've seen some of you made comments on the YouTube video about that. The jobs market, I'm sure, is playing a part in that with all the layoffs that have been coming. That's not a positive. So that kind of leans into the Fed, I think, wanting to get that rate cut in. Then there's a lot of debate on will they say they're going to pause? They're calling it a hawkish rate cut. In other words, they cut, but they say, all right, we cut this one, but we're going to pause for a while. That's what they're terming a hawkish rate cut, which is kind of an oxymoron. But let's get a look at the charts. Yesterday, during our EWO live show for our subscribers at EWO Trader, was watching the rally, said, let's see where we close. Can we close above the 10 and 50-day moving averages, which we did? And then can we get some follow through today, which we're trying to? If so, we are at a time of the year where there's a possibility that we could move higher. The banking system, regional banks are doing pretty well today, which they haven't been. As I've mentioned in the past, banks tend to do well when you're in a easing cycle, so that makes sense. And then tech sector is still struggling a bit up and down. Google, the big winner right now. Everything else kind of struggling along with Google. But can we close higher than the high of yesterday to count as a follow-through day? And with the fact that we are moving into a time of lower volume, a lot of traders take the entire rest of the year off if they have achieved beating the S&P. They don't want to risk their bonuses in the last month. And then even the ones that are here, it's a smaller number. You get that thin volume, and that old adage of never short a dull market tends to come in. And I've also been talking over the past week or two about there's two sides to that, though. With low volume, you could get increased volatility. Normally, you get lower volatility, but if something unusual happens, then you can get a spike in volatility, maybe an outsized spike, and potentially a downward move. But for now, we're going to look and see if this 650 level holds. 660 did not hold. So we came down and tested 650 where there was some other resistance in this area, and now support. If it holds It's only at 21%, so call it the 23.6% retracement. And the algorithm is not confident. And if you're new watching us, welcome to TradeFinder. And I talk about this a lot. The software is from hubb.com. You can get the software for free. You can get the Elliott Wave labeling for free. There is an opportunity to subscribe to AI signals if you'd like, but you don't have to get the software. And then when you look at the algorithm, it's programmed exactly as Ralph Nelson Elliott wrote it. So sometimes there's misunderstanding that I'm labeling the charts with the Elliott Wave labels. It's not me, it's the algorithm. So the price points, all the data that goes into that long algorithm that Ralph Nelson Elliott wrote over 100 years ago is what determines where these labels are. When the label is green, it means that the algorithm is not quite sure that that wave 4 is in. It's still, quote, active, meaning that we could reverse and head back down again. Perhaps the rate cut talk is calming the market a bit. I've been talking about this. You saw the chart. If you looked at the U.S. market update, I think it's all about liquidity. I think that's the key. The Fed has been withdrawing liquidity at a much faster rate than they did the last time they shrunk their balance sheet. That's a pretty challenging environment for markets to go higher. They've told us that they will stop that by the end of November, right around the beginning of December. And at least one Fed governor has said, yeah, ready to start injecting liquidity again. So if we get, even if it's just a one and done pause for a couple of months, the rate cut in December, if liquidity starts coming back in, I think that's going to be more of a driver than the rate cut. I watch that more than this Fed rate cut stuff. The Fed stuff, rate cuts are for, excuse me, no, pardon me. The banks are who benefits from that instantaneously. It takes a long time for a rate cut or rate hike to work its way through the economy, but liquidity can be more instantaneous. So a couple of reasons why I follow that more than I actually do the rate cuts or rate hikes. So again, we'll look and see where we close today. Can we close above yesterday's high? Counts as a follow-through day. And if we can hold above 670 right here, which go ahead and draw that as another point of support resistance. If we can break above that, then maybe we have something. Maybe we are starting to move into some sort of a rally into the end of the year and maybe the beginning of next year. I did show in an event that I did last night, for those of you that may have watched it, on AI fusion and outlook for the coming year. I gave a couple of potential fib targets if we do go to the upside, but also gave what could happen if 650 breaks down. That's where it starts to get real interesting. And there are some fib levels both on the daily and weekly chart that find us quite a bit lower, down in the 575 range is a possibility. So a protracted downward move. If the Fed injects liquidity, I think that's the lesser possibility. But if they continue to tighten the balance sheet and we don't really get the kind of rate cuts that the market seems to want and has priced in, you always have to watch that level. As 650 is just such an important level to hold. So I wanted to show, okay, if we don't hold here, we're talking about if we do, where do we go? All right, well, if we don't, where do we go? So you're prepared both ways. Not much else to talk about on the S&P. So let's move to the bond market quickly. And it has been acting pretty well. And maybe, just maybe, with this gap up today, we had a gap up yesterday. This means buying. Remember, TLT is prices on the 20-year. Prices and yields move inversely. So as prices go up, that means yields and rates are coming down. So rates are easing off a bit here. Is the Fed already maybe starting to put a little bit of liquidity back in? Maybe starting a little bit early. For whatever reason, we are getting some buying in the bond market, and you know contrarian in me always wants to think about, okay, what's the other side? Is money moving out of the equities market into the bond market? Is it a safe haven play that's going on? Or is it perhaps the Fed is back in there? It's an important reminder that the way the Fed, or one of the ways that the Fed controls liquidity, is buying and selling U.S. government bonds and treasuries. If they want to inject liquidity, they buy bonds and treasuries. If they want to withdraw liquidity, they sell bonds and treasuries, or in this case, let them roll off the balance sheet. In other words, the term expires and they just go away, and then they don't rebuy. And that's how they shrink their balance sheet. But now, something's going on here the last couple of days that's pushing rates down. We had the triangle, we broke out, we came back, tested the point of the triangle. Now we're drifting up. So we'll see if we come back up to that same level that we hit. The AI called that level, by the way, even though it was only a 58% chance that we would get up into this 91.5 level. Seems like we may be headed back there now. And then TNX, which is actual rates on the 10-year. So TLT prices on the 20-year, TNX rates on the 10-year are dropping as well. So rates are dropping, and this is the thing that's been a bit frustrating, is any rate cuts or rate hikes have been pretty much uniform across the yield curve from the short end to the long end. And for a healthy economy, you want a steep yield curve, or steepening, at least saying that the economy is getting stronger. We don't have that. It's still flat. And the fact that rates aren't that much difference for a short maturity versus a long maturity is not a sign of a healthy economy. So it only makes sense that you should earn a higher rate for holding a bond or treasury for a longer period of term. But when you get the same in, or close to the same rate for holding a short term, you can continue to roll that over, take the gains, and compound the interest that way, rather than just holding a long-term security. But if the yield curve steepens, then it's more attractive to buy on the longer end. So until the yield curve starts to steepen again, we are aware that the economy's okay, but it's not good. And that's what the bond market is telling us right now. Going to the dollar, still cooperating, hanging in there right at the top end of the Goldilocks channel. I've been calling this, and people were joking about, oh, now I know why you call it Goldilocks, because I was saying I don't want to see the dollar go too low. I don't want countries to start debating about whether they should hold the dollar or dump it with losses in it. And then I don't want the dollar to go too high, because then you start to have a negative effect in the currency exchange rate for companies with international exposure. We do have these two, and so we don't want it too high, don't want it too low, right in the middle, just right, Goldilocks. So that's where that analogy comes from. We do have these two little zigzags here on the dollar, and the levels could get achieved, breaking above. It looks like we're trying to, at this point, test that 100 level and see if maybe it's now support. See how we went up and bumped our head against it, and then came back down, and now we're sitting right on top of it. So maybe we're consolidating a bit here to see if 100 will be the floor. Then we go up and hit those two C wave targets, and if we're going to get that close, might as well follow the Elliott Wave rules that when a wave 5 ends, if it doesn't extend beyond 100%, you retrace back to the previous 4. So that's a possibility, getting up in the 102 area. But we'll see. It's got to get there first. So far, no harm, no foul. We're okay, even though the dollar has moved up some. And Rick Santelli has been saying nobody's talking about it. Well, I am. I have been. So we'll watch. I just don't want to see it go, just like when we were down here and I said, I don't want us to break that level and continue on down lower. I don't want us to break above here either. Perhaps we can expand the Goldilocks channel here a bit, but the dollar is okay, is the bottom line. Taking a look at some of the other markets, we look at the DIA, and 460 is held on the DIA. So that's the first level. That would have been that 660 level on the SPY. The stronger level of support has held on the DIA. If 460 didn't hold, we were going down to 450, but it did hold. And so we're bouncing back up. Not above the 10-day moving average as we are on the SPY though. So kind of interesting that the first level of support held, but not getting quite back above the 10 and 50-day yet. We'll see where we close. Perhaps we do today, but we've got that resistance at 470 now ahead. Interesting that all these lines, the high around 480, support at 470, 460, 450, every block of 10 points on the DIA is a level of support resistance. So I don't know, it's just kind of interesting that it's so uniform that way. But what my point was, getting back above the 10 and the 50-day moving averages are great, but we have to break above 470 as well. If we can do that, then we might have something. Notice that wave 5 went beyond 100%, so you don't look for retracement all the way back down here. So if you're wondering, wow, is the Dow going to go down that far? It doesn't have to, and that's not part of the Elliott Wave rules. If the wave 5 extends more than 100%, which we have here. Looking at the Qs, I mentioned that other than Google having some weakness today, and that goes along with the news on NVIDIA. Seems like some people, you always wonder about ulterior motives when things come out like that on NVIDIA. But once again, I'll talk more about that in a moment. But it is affecting the Qs, and we are trying to get above the 10-day moving average, just not having the same kind of day on the Qs that we're having in the other markets. And we'll see if we can break above this resistance level here around 610 on the Qs. And that you can see that the markets are bouncing off of some support levels and about to test resistance levels. So this could be, and we have to keep that in the back of our mind, just, okay, we sold off, we're bouncing off support. Now we're going to test those old support levels and see if they are now resistance, and we roll over again. That's still a possibility. So don't get too complacent that everything is okay now. The Fed's going to cut rates. Maybe they're going to inject liquidity and we could be moving higher. Maybe so. But once again, this wave 4 that was labeled in the Qs, still green, still active. Not convinced. The algorithm's not that that's going to hold. It might, but it's not convinced of it yet. So we still have to be vigilant and monitor what's going on each and every day, which to me makes it a stock picker's market. Find the best acting stocks and trade those. The AI is great for doing that, but just trading in the ETFs or the indexes as a whole right now is a little precarious with the two scenarios that could either one easily play out. The IWM, I mentioned this yesterday too. I was wondering because the IWM went down with the fact that rates were stable. They had gone sideways for a while. And I also talk a lot about how the IWM is the most rate sensitive of all the markets. And it's also got its own dual mandate, borrowing some Fed speak there, in the fact that it, one, is very sensitive to rates. Small companies, they need to borrow money. And if rates go down, they tend to borrow. They need to grow and expand. A lot of the companies in the Russell don't even make money. They're not profitable. And then the other side is it's a good risk indicator. Small caps, high beta stuff. What's the market's tolerance for risk? That gives you an idea of it. I think right now, on the way down, it was more the market was getting a little gun shy on risk. This bounce back up, I do think, has to do with the fact that rates have ticked up. And notice these last 2 days to the upside on the Russell as prices have gone up and yields and rates have gone down on the bond market. So that plays in, but now we're at a point of resistance. We're the first one to get back here, the IWM, to the support level that failed, and we headed down. Didn't quite make it to this next line that I had drawn. You could move the line up here and say, yeah, we actually did touch it, but I think this is more appropriate place to draw support. Always like it when there's more touches of a line for a support resistance line or drawing triangles, etc. But nonetheless, we are having a nice move up today on the Russell. And can it get above 245? It's a little separated from the 10-day moving average, so you don't really want it to do that yet. Um, and as I mentioned a lot, when you break a major point of support or resistance and you're already overbought or oversold when you do it, it tends not to hold. So what you want is consolidation under this level and then break it. That gives a much better uh, opportunity for the break to actually hold and then move on from there rather than getting turned back. It's just like you're out of gas. I used to use the analogy of a rocket going up, it's going straight up, and then it burns out of the fuel and it just turns and falls back down. It's kind of what happens when you break a resistance level and you're already overbought when that occurs. But is the Russell leading? A lot of people at the beginning of the year favored the Russell as far as their market pick, which of the markets they wanted to focus on. It is performed pretty well. And so, is it a leader? A lot of people, because of the risk tolerance gauge of the market, do think that the Russell can act as a leader. So maybe it's leading us back up first since it's already testing that point of resistance that I mentioned the other markets still need to do. Taking a look at the VIX, we are trending back down a little bit under 20 right now at this moment that I'm talking to you. And so we hit this trend line here, which is the upper trend line from the weekly chart of the VIX. We had the triangle, we broke out, and triangle rules, you come back and test the point of the breakout. We seem to be on our way there now. And once we get there, then what happens? Satisfy the triangle rules, and then we have to wait for the market to tell us where we're going from there. Do we come all the way back down to 15? That would certainly imply that drift higher into the end of the year scenario, as a slow drift higher usually takes volatility out of the market and the VIX could move back down. But as long as we have these big, huge intraday bars, still have to respect the fact that we could get another break to the upside. But maybe this kind of double top type feature here in the VIX at 27.5 was enough. And then we can start a drift back down. Seems to be playing out so far. Looking at the metals market, what's interesting here is that not really following along with what's going on, trying to sneak out to the upside here. But we need more than that. Maybe it's an early indication that we are going to break higher. Remember, any triangle can break either direction. So when we look at this triangle on the GLD, there is a possibility of a downside breakout. You might wonder what could promote that. The Fed disappointing. If the Fed does continue to withdraw liquidity and they don't do the rate cut, then we could have this kind of sneak out here, reverse and head back down. If this breakout here can take out this little high here from November, then maybe we're off and running again on GLD. And then when we look at SLV, same kind of thing here, just a different triangle, descending triangle rather than a symmetrical one, but consolidating nonetheless. And also, just to reiterate, a descending triangle does not mean a downside breakout. Any triangle can break either direction. And we're still along that upper trend line there you can see on SLV. So no breakout yet. And then you can see from the chart, I don't even really have to point it out to you. I think if you break out of the triangle, okay, all well and good, but can we break this bit of a double top here on SLV with that second peak being earlier in November? So the breakout is kind of, in my mind, meaningless unless we break above that resistance line on SLV. Then again, we may have something. And there is a good case to be made for the metals going higher. If the Fed does start injecting liquidity, they do cut rates. That could be the fuel for the metals market to go higher. Looking at the crypto market, it's just a mess right now. Kind of called this one pretty well. There's a comment on the U.S. market update about this that they didn't see these levels that I was talking about as being any sort of high probability of occurring, unlikely to occur, but they did. If we broke this, we had this corridor here around 60 to 62 on the BITB, one of the ETFs for Bitcoin. Again, if you're new, there's the IBIT that a lot of people watch. It has weekly options. The BITB does not. And I just think that trading in the crypto market on a short-term basis is pretty perilous because it's so volatile the way it can move. So I prefer to show BITB because it doesn't have the weeklies and it doesn't kind of encourage people to start trading that short term. And another thing that I wanted to highlight here, if we broke out of this corridor here at 60, we were going to come down to 55. We did. We held there for about a week and said if we break 55, next support is 45. And that's exactly where we went. We touched that support line, oversold from the 10-day moving average. So this little bounce off of here, again, is meaningless because we haven't even gotten back to the 10-day moving average yet. Still technically a little bit oversold on Bitcoin, at least as evidenced by the BITB. We got to get back above the 10-day moving average. And then perhaps there's some room to run up here to test 55 to see what was support. If it's now resistance, you know, the rule, old support becomes new resistance and vice versa. The most encouraging thing to me, I think, giving you a scenario for just a reflex bounce from being oversold, but we're starting to get some separation here between the 10 and the 50-day moving average. And that applies the same way as my 10-day moving average rule that you hear me talk about all the time. No security in any time frame gets too far from the 10-day moving average, at least not for long. Same thing happens when the 10 and the 50 start to gain too much separation. You can see going back here how close they've been. 10-day moving average always leading, but the 50-day not far behind. So when you start to get this kind of separation here, then oftentimes that's telling you that, yeah, we are going to bounce. So maybe we get a bit of a reflex bounce here in the crypto markets, but I'm not saying we're off and running. A lot of people were calling for a big end of the year rally. That obviously didn't happen. We went the other way. So it does seem like we're set up for at least a test of 55 on BITB. Then we'll take it from there, see what happens after that. Ethereum had its own levels. 25 was the key level. If we broke below 27 and a half, we kind of hung around there. Kind of a half-hearted attempt to hold that support, if you will. And my comments were if we broke 25, we're coming down to 20 because you go back and look at July, it was such a vertical move up. There was a vacuum here. There was no real resistance on the way down to 20. So if we didn't hold 25, that's probably where we're going. Note that we're not quite as oversold from the 10-day moving average on Ethereum. At least it's, pardon me, evidenced by the ETHW. Again, an ETF in the crypto space, in this case on Ethereum. But we could have the same scenario. Now that we've retraced this vertical move, one of the reasons I don't like vertical moves, what goes vertically up, oftentimes comes vertically back down. That's what happened. So perhaps we can break above this level here and test 25 on Ethereum. So maybe, just maybe, we're in a little space here where we could see the cryptos turn and go a little bit back to the upside. Now I'm taking a look at the energy space, and I was hoping we were setting up well, but it's not playing out, which is really quite interesting to me to see the way that's working. You can look and see that we were consolidating under 15. Remember, I talked about this for a while, that I thought we were going to see a scenario where the whole sell the rips on natural gas was going to come to an end. The sellers would get exhausted at some point, and then we could bounce up and test 15. I thought it might happen sooner. Back in September, I think I first started saying I think we could go to 15, but UNG wanted to form a base first, so it gave us a nice little base here from 12 and a half and broke up. And then this was good action right here. The fact that we were consolidating under 15, that's what you want. You didn't want it to continue to break on that run there, or you get that scenario where I was mentioning earlier that if you break it then, it retraces and comes back down. So this looked promising as far as an attempted break of 15. I felt like there was a trade there. If we broke above 15, we could be coming up to 1750. But you see what's going on with natural gas today. Now we're back down to the 50-day moving average. Certainly looks like 15 is not going to get broken and it's going to hold as resistance. And that would lead us probably back down to 12 and a half at support level. So there could be a bearish trade there, but the gap down takes some of the steam out of a downward move. But maybe we drift a little bit lower now on natural gas. The same thing is going on with oil. USO also down today. We do have a strangle at Evo Trader for USO. We had one back here on this larger triangle. We are profitable in this strangle right now, and I'm probably going to act just like I did on this first one and pull the exit trigger maybe a little bit early. Uh, Even though we had this large triangle, I drew the support line down there at 65. That was the lows from April and May. I'm just concerned how far OPEC's going to let oil go before they announce a rate cut, because they announced two rate production increases back here when we had these spike up. So I think in their minds, and certainly I can't put myself in the mind of OPEC, but they had a couple production increases that they could take away and still be pumping plenty of oil. So how far down are they going to let the price go before they announce a production cut? So when we broke to the downside here, went ahead and closed it off before we got down to 65. Maybe we make it to 65 this time, but we probably won't hang around that long in this strangle either, just because of having that in the back of the mind. As soon as OPEC announces that they're going to cut production, you can imagine, boom, we're going to get a bid back under oil again. And since we already have the breakout to the downside, we don't want to wait for a whole reversal, let that profit go away, and then wait for it to reappear on the upside. We'll just go ahead and close it off and then wait and see what happens from that point. Look how the AI called that target on oil. That also factored into why I took it off before we got down to 65, even though it was only a 42% chance of coming down there, right exactly to that level. The AI just continues to amaze me. And we will be doing another for those of you that missed out last night on the AI Fusion. We'll be doing another one before the end of the year. I'll announce that pretty soon. So if you missed last night, I think you want to show up for that one and learn more about AI and the more specifics of the levels that I'm watching for our outlook into the end of the year and next year, at least the first part of next year. So I think that oil's going down, the whole energy market's going down. I do think perhaps that consumer confidence number is playing in there. If the consumer is that concerned, are they going to travel as much this holiday season as we normally would? Maybe not. So I think it already had broken down. It was already weakening, but I think that consumer news kind of helped push it just a bit lower in today's market. So I do have a pretty interesting, I think, going along the lines of what I've been talking about, case study consideration for you today. Zack will come back before we wrap things up and show you. Actually, we're going to have an official idea this week, Zack, and had IBB was just a post. We didn't make it an official idea on the social media aspect of the platform, which is so cool. But if you followed along with that, you're probably pretty happy, because look what's happened since last week on the IBB. Should have made that one an official idea, Zack, because that's worked out great. So if you follow along with that last week, you're a happy camper. So let's see if we can duplicate that success with today's idea. So with that, Zack, I'll open it up to Q&A for a while if anybody has any questions, and then we'll wrap it up with the case study consideration for today.
Yep, sounds like a plan. I'll get right into it with a question on Palantir.
The news. In fact, I'm going to go ahead and show you NVIDIA first. I would imagine somebody's going to ask about it. And it isn't quite reminiscent of the old, but pretty close, I think. Talked about this in insiders meetings various times, where there used to be a rumor that would go around, and the favored rumor that would go around is accounting irregularities. And that was back in the days when there wasn't so much electronic trading. The floors were full of traders on the floor, and someone would start a rumor, and nothing would bring a stock down faster than an accounting irregularity rumor. You saw what it did to SMCI, and that has come out today that somebody is questioning their accounting. Now, they're not saying necessarily full-blown accounting irregularities. They're questioning the way they categorize their reduction, the erosion of the depreciation is the word I was looking for. The way they calculate their depreciation, they're feeling like maybe it's inflating what they're actually making a bit the way they're doing it. And so see if that gains any traction or not. But it has, at least for today, threatened to break that all-important 175 level here on NVIDIA. And as I widen the chart back out, if we break that level, you can see we're off the lows. And we are a little bit below the 10-day moving average. So maybe that helps and we recover and get back above 175. We need to do that into the close if you're long NVIDIA, or maybe it's just following Elliott Wave rules. The wave 5 ended, didn't extend beyond 100%. Need to come back down and test that previous 4. We're getting there. Probably one follow-through day would get us down there. But we are a little bit oversold from the 10-day moving average. So maybe we hover around 175 a bit before we drift down, or maybe we just spike down and get it over with. And then we're going to have to watch. So NVIDIA has some work to do now. If we do close below 175, we don't recover it, and we head a little bit lower, then now 175 is going to be resistance, and it's a thick corridor of resistance here, this channel, all this consolidation here, congestion, as I call it, right there between 175 and 185. Can't really feel too comfortable going long NVIDIA again until we break above that level. Obviously, if you're aggressive minded and believe in the long-term story, and maybe that is, I always question when reports like that come out, what are the ulterior motives? So I don't pay any attention to analysts. Analysts have ulterior motives. They work for individual companies, and so their job is to help them, buy low, sell high type of thing. Maybe they're just trying to push the price of NVIDIA down because maybe there's some institutions that want to get into NVIDIA but would like to do it at a lower price. So you just never know what the motives are on reports like that. But this kind of stuff can take a life of its own, as what happened with SMCI. Theirs was exacerbated by the fact that their accounting firm quit. That's not good if you're getting comments on suspicions of accounting issues. And it's taken the wind out of SMCI, and it has not recovered yet. I still think this could outperform. I think for next year, SMCI could be a good one. I've been talking about that for a while. Still feel that way. We're trying to build a base down here in this area. We'll see if that can act like the base did in natural gas. I've got too many lines on here. Let's take all this stuff off now so that I can spread the chart out and you can see it a little bit better. Then also notice a little separation here between the 10 and the 50-day going back once again. See, every time it separates, how it comes back. That's why I was telling you about that rule between the 10 and the 50-day. And so this is even more separated than either of these two moves that I just showed you. So maybe we're sitting into a point here where SMCI can bounce back up. And so I do like this one moving forward. And you could get some outsized gains, I think, if the market does continue back to the upside. We hold 650, don't break down, don't roll over significantly in the markets and head higher. Could be a good place to outperform the rest of the market. And as we move into December, maybe that's where some of the and statistics show that there's a lot of money managers that have underperformed the S&P. Everybody's been waiting on corrections, and the market kept going up, and there's money managers that have underperformed. I've mentioned this before too. Money managers, yes, are paid well, but their big money comes from bonuses. If they beat the S&P, they get an end of year bonus, and that's where a big chunk of their revenue, their income comes from. And so for those that have not outperformed the S&P yet, they're performance chasing. One of our subscribers, Maria, had asked about that in the past. And this is the kind of thing they're looking for, in my opinion, is where are stocks and sectors that have performed well that have underperformed? And if things do calm down, pardon me, and get a little bit more bullish, where can they outperform the S&P into the end of the year so that they can show numbers that beat it and get their bonus. So we'll keep an eye on that. But the question was on Palantir. Sorry about that, Zach. Sorry, everybody. I didn't mean to go too long, but I thought those were things that were important to say. And Palantir has been correcting ever since its earnings report. Gave a glowing earnings report, glowing guidance, but the multiple finally got it. The market weakened a bit, and so now we've taken some of that froth, if you will, out of their valuation. And 150 is a pretty good level. We talked about that if it didn't hold 170, it was probably going to come down to 150. Boy, did it do it quickly in 2 days. So we've held 150 here. Now can we bounce back? It's got some work to do, kind of like NVIDIA is going to have some um, forceful moves here to break above these resistance levels. It's trying to get back above 160 already, but it's got to get it back above 170. That's the level you want to watch because of this corridor of, again, congestion. Break above 170, and then maybe we turn and start to head back up and test 190 again, but that's down the road. So first things first, get back above the 10-day moving average, and it's so close to 170. That'll act as resistance as well. You can see all these times we touched 170. That's how strong this support level was. And for it to break, you can see why people quickly bailed, and we had the big quick downward move. Now, can we reflex bounce? Can we get back above? But nothing matters on Palantir until it's back above 170. If it breaks 150, yeah, then it gets pretty dicey.
Thanks, Rob. Excuse me. Will ask, can we look at OKLO as a downside play?
We can. I think we looked at this one before and said it had the potential to be one. It kind of is, and head and shoulders patterns are always difficult because they're never perfect the way they work out. But this one has some characteristics of it. You can see maybe a left shoulder there, head, right shoulder, pretty similar spot. So the neckline somewhere in here. And if you measure the neckline at the top of the head, 125 up to almost 275 points. And so if you subtract that, that's rules for a head and shoulders pattern, you measure from the neck to the top of the head, and then the distance from the neckline down, that same price level is what usually happens. The issue here, Will, is, it's made this big move down already. And based on head and shoulder rules, we could go lower. We could go down to 50. I don't know that it's going to be on the speed of the move that we've had to the downside already, because that corridor right there that we're in here has an awful lot of congestion through it here. Any of these areas could provide support. So I don't Could it go lower? Yes. And if it follows head and shoulder rules, it should go lower. I just think it's going to have a difficult time due to the fact that we have all this congestion through this corridor. It's going to have multiple support opportunities. So maybe it's up, down, maybe two steps down, one step back up type of thing. The possibility is there. But the easier move was from 125 down here to 85. And now I think it'll be a little more challenging to move lower. We also have a wave four right in that 61.8% level. So it's possible to hold here. So that's a tough one, Will, because if we wait for the higher probability entry, that would be breaking down here below the 70 level. And then 50 isn't that far down from there. So yeah, it's challenging now, but we'll see. You take a shot at it, but if it bounces here, that shouldn't be too much of a surprise either. So yeah, that's a tough one to go lower from here.
Very well. This next one I had addressed, I think it came up last week, and since it came up again, I figured it'd be best to pass through to you to be able to provide your thoughts and insight on it. It says if SPY goes higher than purple 3, will the green 4 turn purple?
Once the algorithm is convinced that that 4 is complete, it's just active right now. And again, I'm not mathematically inclined enough to fully understand the ins and outs of the algorithm. It's pretty complex. It's about 20 pages of coding that Elliott wrote a long time ago. He's way ahead of his time along those lines. So when the algorithm feels, based on the price action and how it fits within the algorithm, that all right, that 4 likely is in, it'll turn purple. Then we can start looking towards the wave 5 rally, and it may do that any day. For now, we just have to say we got to keep in the back of our minds that this could roll over. But it's acting, and um, if the Fed follows through with liquidity and the rate cut, you would think that would keep a floor in the markets, and then we can turn and go higher. But yeah, that's the algorithm determines that once it feels that, or the data is within the math that Nelson wrote.
Thanks, Rob. Next up, question from Jeff on Zoom. I got in on this jump today. Do I bail out?
That's everybody's personal preference there. And I can't, make that call for you. Can't give individual investment advice. But I can say, if you've watched, I think I've been pretty consistent on this. It's just my general viewpoint that when you get a day like that, depends on whether you own the stock or the options. If you own the stock, then you may want to hang in and see if it can go higher. If you own the options, you're getting an amazing IV rush into the call options today. And I tend to want to sell that. I view that IV rush as free money. Even if the stock could go higher, I still want that. So when you get days like this, I tend to get out. So congratulations on being in this great trade. You can also see how far separated we are from the 10-day moving average here, and that's pretty extended. See what happened last time it did that? It went up and it consolidated and then came back down and gave some of that move back. And the concern along those lines is Oracle. Remember, they gave their great guidance and they went up and gapped up, and look what happened. Been moving down ever since, and now there's all this negative news about how much money Oracle spends, etc. And not only did it recover the gap up, we broke below support on NVIDIA, and then AMD had that big bounce, and it's trying to come back down. I'd mentioned I'm going to watch that one and see if that's going to be another Oracle and fill the gap, and it sure looks like it's on its way to doing that. Here was its gap coming back down, so Yeah, I mean, I can't tell you what to do on that Zoom trade, but again, congratulations. And if I had calls on it, I'd take that free IV. That's what I would do.
Thanks, Rob. Next up is BMNR for Lisa.
Yeah, what's going to happen? All these Bitmine issues here. Tom Lee has an affiliation with them. Uh, did this move? Is this brand new or did it move exchanges? Let me see if there's more data on a different one. But if we start to get, if we start to get a little bit of a reflex bounce in the crypto space, this one could take off. This looks like it just started trading. It looks like a new issue, but I feel like that symbol's been around. Well, um, only shows on the Amex, but not enough data to figure out what to do here other than just follow the main sector uh, in the crypto space. And if cryptos do get at least a reflex bounce, that probably goes higher.
Thanks, Rob. OUST.
Ouster. Pretty interesting name with what's been going on in the markets. Um, really had nice consolidation there at 30, but it's broken down. We're starting to get to an area here where maybe it could hold. You can see that, and I'll condense the chart a little bit more. Uh, right there, where it's trying to hold, we had a doji there, and you can see why. We go back and look at it, it based at 10 for a very long period of time. And then it kind of crept up, kind of looks like maybe some institutional buying there. That's what the bars look like when institutions are buying. They're small, they kind of sneak in. They don't want the big bars that attract people. They try to come in and buy under the radar. And then it consolidated that move really well at 30, but then it gave it all back up. So yeah, I think if you want a place to put a little bit of um, higher risk, and I always say that because it doesn't fall within some of the other rules yet, but it does have a nice wave four there on the Elliott Wave pattern. And notice that one is purple, and it's right at the 61.8% fib level. So we're sitting on a good area of support and a strong fib level and a little bit of separation here between the 10 and the 50. So I think this is one that on top of that, your stop would be right there at support. So if it breaks that level of 1750, then you're out. So 1750 would be your stop and give that one a chance to move higher. I think that one could work out. I like that one as well.
Very well. Thanks, Rob. I see we are coming up close to time. Do you have time for a couple more?
Yeah, let's do a couple more and then we'll do um, today's case study consideration.
Sounds like a plan. AAPU. Sorry, AAPU.
Oh, okay. I was going to say we haven't looked at advanced auto parts in a while. Remember my caution on these leveraged ETFs. The way they get the leverage on this two times performance is by using futures contracts. So time decay is a double whammy. There's no question that you can make money on these if you get the timing right. If you get the timing wrong, you can end up being right on the movement in price. But if it takes too long, there's so much erosion of time decay if you're trading the options on it that it erases your gains. It makes it very difficult, but you get the timing right, then it could work. So this one's on Apple, and we'll go look at the chart of Apple, I think, to give confirmation there. It's encouraging that it's breaking above this 37.5 level today. You know what I'm going to say, though. One day doesn't mean anything. You have to have a follow through or confirmation day to move through there. But it's trying and certainly could have some upside there up to 40 or so if it's able to break above it. So it has the potential. And the market is happy with Apple right now. And I think it was really having trouble here, consolidating at 270, just kind of sitting there. And then the news came out that they're going through their early succession plans on who's going to replace Tim Cook, and people seem to really like the person that they're talking about as more of an innovator. I've always criticized the fact that Tim Cook was a manager. He just kind of managed the portfolio that they had of products and just raked in the cash, but there was no real new innovation. But um, I think what's put this bid underneath this is some excitement over who may be coming in and what the future of Apple could be. So looking at that, we're not quite in the tractor beam, but we're pretty darn close there at 280. And if you're not familiar with what's the tractor beam, that's just a nod to my dad, who was a big Star Trek fan, was on the TV all the time when I was growing up. And you know that the Enterprise, if it got near a planet, it would get sucked into the tractor beam and it would draw them right to the planet. Well, those big round numbers are what the draw is for the tractor beam. And now that we're up around 280, pretty hard to imagine Apple not going to 300. So I feel like that could happen. So then your AAPU should perform well also. Just always like to caution people that you've got to be right on the timing on those leveraged ETFs. All right, one more, Zach, and then we'll do today's.
Alrighty, last one will be CRWV.
CoreWeave, and kind of got this one pretty well also, that if it didn't hold 100, watch out below. Another one. So the market's starting to look in some of these charts where we're getting a lot of separation here between the 10 and the 50-day moving averages. It feels like the market wants to, if nothing else, bounce into the end of the year. The negative here is clearly the lower high on CoreWeave, and we're not even in that stratosphere yet. We're trying to figure out where we can hold, and 100 needed to hold. It had a tiny little bit of other support right there, right below that, and it didn't even blink breaking through there. Now we're trying to kind of hang in here, but I would not be surprised to see CoreWeave work its way back down to 50 to where the big support is. It's really in no man's land right now. That break through that corridor was big. And, the NVIDIA news, et cetera, what's going on in big tech it's not helping CoreWeave too much. Maybe it can hold here, but it went straight up from 50 to 75. So I've shown you all those charts on where these vertical moves that occurred back in the spring have all been retraced and corrected. I think there's pretty good chance CoreWeave does that as well. Will, if you're looking for another downside trade, maybe take a look here as well. Uh, it would surprise me if it held here. Even if it does, it's got that same problem I've been talking about. Even on a bounce, it's got some work to do with resistance ahead to move higher. So that one could be a good one. All right, Zach, we'll move over, and I got one that I think is interesting based on what I've talked about here and the Fed news of the day, et cetera, is on. Columbia Banking, CBS. Gosh, we've moved higher since this morning. So we're almost to the target on that one. So not that much move left. There's only another, it almost got there. Well, it was a good one. You can see that it had all this resistance here and um, a target for the AI, pretty high score there, 76% chance, but it's continued up throughout the day. When we see that, it could have go higher because it had all this resistance and broke out. Anything affiliated with banking seems to be doing well today. Let's see what the DMI says. Well, the ADX isn't quite high enough yet to break above that level. Yeah, I'm going to have to change the plan here, Zach. When we look at this, Medtronic, we'll go with this one because it's got more room to go here to the upside, and it also has a more mature DMI. And you can see the ADX hasn't gotten to 40 yet, so yep, we kind of missed the COLB one, but I think this is an 80% score is a high score here. You might get a little consolidation here because we're a little bit past the 10-day moving average. But one thing that we've noted out of the AI is it really does good job of catching stocks in a momentum phase. Sometimes they just continue, boom, run straight up there. Those of you in Top Shot saw that with ORI. If it continues up like this, it could go vertically all the way to the target. But don't be surprised if it does a little backing and filling for a couple days before hitting there. But at least that one has a little bit more room to run and a more solid. We could be really in the early days on COLB. I think we keep an eye on that. Hitting this AI target, that doesn't always act as the ceiling where you smash your head against it and that's the end of it. Sometimes they run on past these AI signals, but to kind of bank on that, pun intended, got to have that ADX above 20 now for that. So skipping that one, we'll keep an eye on it, put it on a watch list, but our case study for today's act's going to be on Medtronic, MDT. I like the sector it's in. I like what the company's doing. All kind of makes sense. So we're going to look at that to go up to 108.
Sounds like a plan. And is that going to be an official idea as well?
Yes. Not
Alrighty.
much of a move. I know it's not a very big move, but um, it looks pretty promising.
I'd
Sometimes
agree.
small moves in this environment are good. Sorry.
Oh, no, no worries. And I agree. I mean, 80% AI score is also supportive, very strong. So let me go ahead and take the screen here. And we should be at the homepage menu view of the platform. As Rob just said, we're doing an official idea for this week. So I'm going to go up to the light bulb over here on the right, top hand right side over to new idea. And as it's going to be an official idea versus a post like we've had in previous weeks, we'll enter in our title here for stock MDT. And that target price was 108. Is that correct?
Yes.
And the time frame we're looking at for that?
We can just stay with the 3 months. It's good for your trading options, even if it gets there in a short period of time anyway.
Very well. We'll go a quarter out. And as I always say, we'll come back and make this look nice and pretty with more supporting details right after this session concludes. But as you can see, it is posted and available for you to come in and interact with. As you can see with all the ideas from our ever-growing community, you always have the option to agree, disagree, and share your thoughts why. Again, a lot of you have probably heard me say this in the past, but for anyone that might be new or joining us for the first time, whether you agree or disagree, we always welcome your opinion. Opposing opinions is what makes markets. If everyone agreed, there'd be no trades, no transactions to take advantage of. So we have a very respectful and ever-growing community that's been very motivating to watch and interact with. So again, whether you agree or disagree, please feel encouraged to add your thoughts and comments. And again, just obviously be considerate of the community. But other than that, I think that wraps up my little spiel for today. And I'll pass back over to you to wrap the session up, Rob.
All right, sounds good. And furthering your commentary, I get notifications from hub because I'm such a big fan of the social media platform here. You know how many traders are on social media platforms and sometimes posting pie in the sky ideas, etc. I love doing Trade Finder each and every week. I always say that's my favorite show of the week because this community, you guys ask such great questions. You find good stocks. It's always a fun event for me to do, and that's reflected in the commentary that gets posted on the social media platform there. And you get people, voting on your ideas, and don't get upset if somebody has a differing opinion. Oftentimes, somebody may come up with something you hadn't thought of. It's a learning tool to go through, pick your idea and see. Maybe the majority agrees with you, and that always feels good. But if they don't, then you're like, why aren't they seeing the same thing I am? And again, you can learn from that. But it's growing every day. As I said, I get notifications. I think it's going to be the epitome of social media platforms in the future based on it, the way it's set up, etc. It's pretty cool rather than just posting a comment somewhere on other platforms. So, with that, I'd like to wish everyone a very happy Thanksgiving to you and yours. Enjoy the holiday weekend. We'll see if we can continue to drift higher in the market as we move into the low volume part of it. You could argue that today's close is super meaningful because a lot of traders are going to take the rest of the holiday off. They'll take tomorrow off and through only a half day that the market's open on Friday. So they just use this as a 5-day weekend now. So today's close is important, and maybe we have something underway here to the upside. We'll just have to wait and see. So once again, happy Thanksgiving, everybody.